If I look at what the bond market's pricing, which is now essentially 3 cuts and the Fed is talking about 2, the bond market is saying the Fed is behind in terms of how they're perceiving these changing conditions. And so I think on the 17th, when the FOMC makes its rate decision, I think there is a chance the Fed responds to that. And if it does, it's going to be good news because the bond market is going to take comfort from the Fed recognizing the labor market's weakening.
This one stock could shock you. While markets have been rattled by crash narratives, it just surged over 24% in a single week. 4 straight days of gains pushed it to a fresh 52-week high at $257 before cooling to $242. Why? Investor optimism from a semiconductor giant spilled directly into this tech stock, and with a major new deal on the horizon, the stakes have never been higher. Is this just momentum or the start of something much bigger? Stick around, because I'll break down the fundamentals, the technicals, and the risks you need to watch. Plus, reveal 3 other AI stocks that could be game changers too. Before we dive in, to celebrate hitting 5,000 subscribers, I'm giving away a free guide on spotting breakout stocks. The link's in the description. And quick reminder, this video is for educational and informational purposes only. It's not financial advice. Investing in stocks is risky, so always do your own research before making a move. If you're ready to think differently and stay ahead of the headlines, hit that like button, share this video, and subscribe. Let's dive in. The AI saga is only beginning, and the real money may not be in the headlines you see every day, but in the infrastructure humming behind the scenes. Cloud computing, data centers, and the flood of generative AI workloads are driving an insatiable demand for capacity. According to Bloomberg Intelligence, the generative AI market could soar to $1.3 trillion within the next decade, up from just $40 billion in 2022. IDC projects that AI spending will expand at a 31.9% annual rate from 2025 to 2029, ultimately capturing more than a quarter of global IT spending. That's the backdrop for Celestica, ticker CLS. Often overlooked, this Canadian electronics manufacturing powerhouse is no longer just an EMS player. Instead, it has quietly positioned itself at the core of AI's infrastructure boom, building switches, servers, storage controllers, and interconnects that power hyperscale data centers. Here is why CLS has been one of our most standout tech stock on this channel since last year, 2024. First, the hyperscaler tailwinds are mind-blowing. Demand for 400G and 800G network switches is exploding as Microsoft, Meta, and Amazon race to scale. Celestica's Hyperscaler Portfolio Solutions (HPS) business now makes up nearly half of revenue. Secondly, portfolio expansion. From Broadcom-powered 800G switches, DS4100, to AMD EPYC-based storage controllers, SC6100, Celestica is engineering the essential components of AI. Then, what is investment without its financial firepower? Expected revenue growth of 20.6% and EPS growth of 43% this year, with consensus earnings estimates up nearly 10% in the past 60 days. Q2 revenue jumped 21% to $2.89 billion, and free cash flow surged to $119.9 million. Capital discipline. CapEx is held to just 1.1% of revenue, with most of it allocated to growth rather than maintenance. Inventory is scaling strategically to meet rising demand without choking cash flow. Global resilience. With facilities in 16 countries and supply chain diversification across Asia, the US, and Europe, Celestica has successfully navigated disruptions from conflicts and tariffs. However, we are also concerned about the risks investors should weigh. Celestica trades at a forward PE of 33, which is well above the industry average of 21. Heavy reliance on a handful of hyperscalers, while lucrative, introduces concentration risk if spending slows or contracts shift. Add to that rising competition from Jabil and Sanmina, and execution remains critical. Shares have surged 139% in the past 6 months, outperforming Jabil plus 45% and Sanmina plus 54% by a significant margin. Analysts expect momentum to continue into 2026, with CLS maintaining a top-tier ZAX industry rank. Yet, trading at a premium valuation, the stock has little room for error, and every earnings report becomes a potential catalyst or stumbling block. Celestica isn't chasing AI headlines, it's quietly building the backbone that makes AI possible. From high-speed 800G network switches to servers that power hyperscale data centers, CLS has emerged as one of the most overlooked winners in this AI gold rush. Now, let's look at the chart. The stock has surged over 100% this year, now trading around $244. But the story is still unfolding. If Celestica can break above the $259 resistance zone, the next move could target $275 to $279. For disciplined buyers, pullbacks near $242 to $243 remain attractive entry points, while $202 is strong long-term support. Bottom line, Celestica is executing with precision during one of the biggest tech buildouts in history. For long-term investors, this is one AI infrastructure stock that deserves a closer look. The next stock is Soundhound AI, ticker SOON, the voice behind the next wave of AI. The last time I covered Soundhound, I flagged the mismatch between its exciting growth story and the strain on its balance sheet. Yes, the company had impressive revenue growth and marquee partners, but cash burn and dilution left me skeptical about its long-term performance. With the stock sliding nearly 25% year-to-date, it is now trading around $15.14, well below its 52-week high of $24.23. But here's the twist. The company's latest quarter has re-energized the bull case. Soundhound delivered record Q2 results with $42.7 million in revenue, more than 200% growth year-over-year, and well ahead of Wall Street expectations. Losses narrowed significantly, with EPS improving to minus 0.03 versus minus 0.11 last year. That's progress. The company also raised full-year guidance, citing accelerating adoption across its three verticals: automotive, enterprise, and restaurants. The automotive segment is especially promising. Jeep has now deployed its Soundhound Chat AI Automotive in select European vehicles, a real-world milestone that blends voice interaction with generative AI. Despite these wins, SOON remains volatile. In fact, it's logged more than 90 moves greater than 5% over the past year. Momentum traders love it, but long-term investors need to stomach the swings. In the near term, resistance sits around $18, while the RSI suggests there's still room to run before the stock looks overheated. Analysts now expect $40.1 million in Q3 sales, a 60% year-over-year jump, with full-year revenues forecast at $165.6 million and nearly $215 million by 2026. On paper, this paints a compelling growth trajectory. The hard truth remains cash burn and valuation. Here's where the skepticism comes in. Soundhound raised $267 million last year by selling stock, diluting shareholders to keep the lights on. Cash burn totaled $112 million, and while the growth narrative is bright, profitability still feels distant. At current multiples, the stock trades well above sector averages, a premium that demands flawless execution. For now, Soundhound has momentum, recurring revenue opportunities from voice AI deployments, and a growth engine firing on all cylinders. But the risk lies in whether it can bend its cash burn down before investor patience runs out. For traders, the near-term momentum could push it toward $18. For long-term believers, it's a bet that today's volatility hides tomorrow's market leader in voice AI. The question for investors is simple. Do you trust the growth curve enough to ride out the dilution and volatility, or do you wait for a clearer path to profitability? Moving to the next pick, Nebius Group, ticker NBIS, just stunned Wall Street with a blockbuster win. The Amsterdam-based AI cloud company secured a deal with Microsoft worth up to $19.4 billion, sending its stock soaring more than 40% in after-hours trading to a record high. Under the agreement, Nebius will supply GPU-powered infrastructure from its new data center in New Jersey through 2031. The partnership positions Nebius alongside Coreweave as a critical AI compute provider for Microsoft's expanding cloud footprint. For investors, the appeal is clear. Long-term recurring revenue tied to one of the biggest names in tech. But the risks are real too. Heavy capital spending, reliance on NVIDIA hardware, and the ever-present danger of an AI bubble correction. In short, Nebius just put itself on the AI infrastructure map. The question now, is this a breakout opportunity, or has the stock already priced in perfection? Next is Applied Digital, which is quietly carving out a critical role in the AI infrastructure race. The company recently secured a lease with Coreweave for an additional 150 MW at its Polaris Forge 1 campus and kicked off development of Polaris Forge 2 in North Dakota. These moves aren't just about expansion. They're about locking in long-term revenue streams tied to hyperscaler demand. Despite these milestones, the stock has remained flat over the past quarter, echoing broader market stagnation as speculation about Fed rate cuts and shifting bond yields kept investors cautious. Yet, the one-year picture tells a different story. APLD has outpaced the U.S. IT industry's 22.7% return, underscoring confidence in its model. At $13.89 per share, Applied trades at a 26% discount to the consensus target of $19.38. That gap signals skepticism about its aggressive build-out strategy, but it also highlights potential upside if management delivers on its scaling roadmap. For investors willing to weather short-term volatility, APLD is a calculated bet on the hidden infrastructure powering the AI boom. Moving to Coreweave ticker CRWV, the company is doubling down on becoming the backbone of AI. The GPU cloud specialist has just signed a deal to acquire OpenPipingC, a rapidly growing platform for reinforcement learning, RL. By integrating OpenPipe's developer tools, Coreweave strengthens its position in training adaptive AI agents, adding another layer following its recent acquisition of Weights & Biases. The company also struck a $9 billion all-stock deal for Core Scientific, CORS, aiming to combine CRWV's AI HPC cloud workloads with Core's deep expertise in data center construction and power procurement. This integration could lower lease obligations by $10 billion and expand vertical control across the AI stack. But there's a catch. Coreweave's expansion spree is piling on risk. The firm has raised $25 billion in debt and equity since 2024, leaving its balance sheet heavy. At 15.36x price/book, shares trade far richer than the Internet software services average of 6.7x. Investors are left asking, is Coreweave building an AI empire or over-leveraging itself into vulnerability? Some are low-risk bets. The real question is, do you stick with the leaders or bet on the underdogs that could be tomorrow's winners? If you had to pick just one of these 4 AI tech stocks for the rest of 2025, which would it be and why? Drop your answer in the comments.